With tariff talks top of mind, South Florida farmers say they're in trouble. Crops are rotting on the vine, and they're blaming the ongoing trade wars and immigration changes.
It all started with a tax order. Just one government decision, and suddenly the U.S. finds itself short on tomatoes and losing more than just produce. If your pizza seems more expensive lately, you're not imagining it. While Washington tightened the door on Mexico, Ottawa quietly opened theirs, and Canadian farmers are the ones cashing in. But behind the headlines and the multi-billion-dollar numbers are things that hit closer to home. Pre-share ketchup, restaurant menus being trimmed, and everyday Americans footing the bill for a political move. What's really going on? Here's the picture. Starting July 14th, 2025. The U.S. Department of Commerce officially pulled out of its tomato trade suspension agreement with Mexico, imposing a 17% tariff on all fresh tomatoes coming in from our southern neighbor. The reason? To prevent underpricing and to support struggling farmers in Florida and Arizona. But there's a catch. Mexico supplies about 70% to 93% of the fresh tomatoes consumed in the U.S.A. So, this policy shift hit like a shockwave. If you usually buy a box of tomatoes for around $3, expect to see that jump to $3.30 or more within a few weeks. And it doesn't stop there. Pizza sauce, ketchup, salsa, these staples could all see price bumps. That burger or pizza slice you enjoy might soon cost an extra 50 cents to $1. While the U.S. was closing the gate, Canada was busy rolling out the welcome mat. In July 2025, Mexico's President Claudia Sheinbaum met with Canadian Prime Minister Mark Carney to announce a major expansion of their agricultural trade relationship. Mexico's cold chain logistics sector, critical for keeping produce fresh, hit $4 billion in value in 2024 and is expected to reach $6 billion by 2029. That's a solid base for tomato exports to grow fast. In the first half of 2025 alone, Canada pulled in $2.8 billion in tomato revenue, largely from rerouted Mexican supply. And with fewer trade hurdles, Canadian shoppers are getting top-quality Mexican tomatoes for around $2.50 a box, roughly 20 to 25% cheaper than what U.S. shoppers are paying at the same time. Pulling out of the Mexico agreement has led to real supply gaps in the U.S. Tomato prices are expected to rise another 6% to 10% by August 2025. Restaurants and food chains, Wendy's, Taco Bell, even household names like Heinz and DiGiorno are all rethinking their game plans. A 30 secuos bottle of Heinz ketchup that used to cost $4.29 is now listed at $4.79 in major chains like Target and Walmart. Smaller restaurants are either raising prices or cutting back on tomatoes in their recipes. That means American diners are now directly feeling the impact of a trade policy that may have sounded distant, but now hits right on the dinner plate.
Japan has formally rejected a request from President Donald Trump to increase U.S. rice imports, despite warnings of potential new tariffs. Could this firm stance trigger a deeper escalation in U.S.-Japan trade tensions? The Japanese government announced it would not sacrifice rice farmers to meet U.S. trade demands, even after former President Trump warned of new tariffs if Tokyo failed to increase rice imports from the United States. According to Reuters, Japan imported $110 million USD worth of American rice during the first 4 months of 2025 and nearly $300 million in 2024, a notable rise compared to prior years. Despite that, Tokyo remains committed to its 770,000-ton import quota under WTO agreements and imposes high tariffs on imports exceeding that limit, a safeguard intended to shield domestic agriculture. Japan's stance reflects not only economic policy, but also political strategy. Rice farmers, concentrated in rural prefectures, are a key support base for the ruling Liberal Democratic Party, the LDP, which faces an important upper house election on July 20. At this critical moment, protecting rural livelihoods and price stability is viewed as a higher priority than making external trade concessions. From a domestic perspective, Tokyo's position aligns with broader concerns about rising food costs and climate-driven supply pressures. With rice prices already under pressure from poor harvests and elevated input costs, Japanese policymakers are focused on maintaining stable agricultural output and shielding consumers from additional volatility. Since the 1970s, Japan has run one of the world's most extensive farm protection programs, including subsidies to reduce rice production. Though officially ended in 2018, the government continues to incentivize shifts to soybeans and other crops to control domestic rice output and prices. In 2024, extended adverse weather reduced crop yields, while rice consumption among younger generations declined. As a result, domestic prices doubled. A 5-kilo bag of rice in Tokyo now costs around $30, placing added strain on households with limited incomes. This shift affects more than grocery bills. Schools and urban families are rethinking traditional meals, turning to cheaper staples like noodles, bread, and imported grains. Long-term, such changes could alter the culinary identity of Japan. While current tensions center on agriculture, broader trade impacts are emerging. In response to tariff threats, Japan imposed a 25% duty on certain U.S. auto and metal exports. With no new bilateral trade deal in place, American industries now face both reduced market access and higher costs. The uncertainty has rippled into financial markets. In early 2025, the U.S. dollar experienced its steepest decline since 1973, driven by concerns over rising federal spending and failed negotiations with key partners like Japan. Meanwhile, Japan's Nikkei 225 index dropped 1.2% following Trump's tariff comments, reflecting investor unease over unclear trade policies. For American consumers, continued friction could lead to higher prices on goods reliant on Japanese parts and materials. States with strong ties to automotive and metal industries may also face job losses and stalled investment if tensions escalate without resolution. Canada is making bold economic moves as U.S. trade policies trigger a wave of responses. Could these changes quietly reshape what Americans buy and how much they pay? In 2024, the Trump administration imposed a 50% tariff on imported aluminum to protect U.S. metal industries. According to the U.S. Census Bureau, prices of aluminum products rose 22% within months. This hit American manufacturers and construction firms hard, especially those reliant on imports. Canada, which supplies over 70% of North America's aluminum, responded strongly. Aluminerie Alouette in Quebec announced a $1.1 billion plant modernization, powered by low-cost clean energy from hydro, Quebec. Quebec's economy minister stated, "The U.S. depends on U.S. for aluminum, and we won't stand by." For Americans, the effects are immediate. The price surge affects home renovation, auto repair, and beverage packaging. Costs on products like soda cans and appliances may rise, adding up to $2.5 billion annually for U.S. consumers. Small businesses in construction and manufacturing face tighter margins and difficult decisions. Canada is rapidly diversifying trade. In early 2024, non-U.S. exports rose 18%, while U.S. bound exports fell to their lowest since the pandemic. Gold exports to the U.K. jumped over 30%. Crude oil to Singapore hit records, and Italian imports of Canadian aluminum and pharmaceuticals reached all-time highs. Pork exports to Japan rose 13%, with Canadian food favored for its clean, traceable image. As Canada looks beyond the U.S., American buyers risk losing access to key supplies, from metals to pharma ingredients, weakening supply chains, raising costs, and reducing product availability. U.S. consumers may face higher prices or longer wait times for top quality goods. Canada's Industry Minister Melanie Joly criticized the Trump administration's trade tactics, saying, "We are in a tariff war, and negotiating with the U.S. is tougher than ever." She announced a 3-point response: stronger anti-dumping rules, better liquidity support for industry, and faster project approvals, cut from 5 years to 2. Joly also introduced incentives to attract top researchers, noting Canada welcomes talent, especially as academic freedom faces challenges in the U.S. Canada's assertive approach may heighten competition for talent and investment. U.S. universities and tech industries risk a brain drain as researchers and students OPT for Canada's more supportive environment. This could affect American innovation and growth in tech, biotech, and energy. Canada is investing heavily in green energy, hydro, hydrogen, and advanced fuels to lead the global energy shift. High-value exports like battery tech, advanced materials, and aerospace are priorities. The goal? Commercial independence and freedom from Washington's changing moods. If Canada becomes a clean tech and export leader, U.S. industries could lose a key supplier and tech partner. That could mean tougher competition, reduced influence in North America, and, for consumers, fewer options, and higher costs for next-gen products like EVs and energy-efficient appliances.
The height of when we are out of Canada's growing season, we could be upwards of 60%, 70% American produce, okay? Right now, we're only running at about 30%.
As corn shipments rejected, Canada takes advantage. A farmer in Iowa just posted his nearly new combine for sale because there's nothing left to harvest. American corn was once king at the trade table. Now it's getting turned away at ports, while Canada is quietly locking in billion-dollar contracts. So how did everything shift so quickly? 1. Canada cashes in on billion-dollar contracts. In 2025, rising export inspection fees pushed U.S. corn prices in the Midwest below $3.5 per bushel, lower than the cost of production for many farms. That's made it nearly impossible to turn a profit. As a result, international buyers are backing out of U.S. deals, and cargo is getting rejected at port. Meanwhile, Canada has stepped in, signing lucrative agreements to supply premium corn to markets like South Korea, the EU, and Mexico. For American farmers, this isn't just economic theory, it's hitting home. If you've been hearing chatter about cheap corn, you've probably seen the effects already. Full silos, deferred maintenance, and families debating whether next year's crop is even worth planting. In rural towns, grain elevators are full, and local banks are tightening credit on new equipment purchases. That shiny new tractor your neighbor bought last year, it might be parked for good this fall. Low corn prices and shrinking exports are creating a domino effect. Ethanol production heavily tied to corn is scaling back hard. According to the U.S. Energy Information Administration, more than 25 ethanol plants in Iowa, Nebraska, and South Dakota have reduced output or temporarily shut down since early Q2 2025. If you or someone in your household works at one of those plants or hauls the grain that feeds them, you've likely seen reduced hours or the threat of layoffs. In some counties, ethanol is the largest local employer, so when those jobs go, the entire economy feels it. Grocery stores, repair shops, even local schools. And for everyday drivers, supply shortfalls in ethanol blends like E10 and E85 mean prices are rising. A fill-up that cost $2.8 per gallon last week could be $3.10 today. A 30-cent jump that adds up fast for commuting families. As corn loses key export markets. It's not just at home. The U.S. corn industry is losing ground worldwide, with corn prices too low to cover operating costs. More than 25 ethanol plants in the Midwest have scaled back or shut down. Meanwhile, major buyers like Mexico, once a $5 billion customer of genetically modified GM corn, are stepping away. Their Congress just passed a ban on planting and importing GM corn, citing environmental and health concerns. Losing Mexico, the second largest export market for U.S. corn, leaves farmers stuck with full silos and nowhere for cargo ships to go. If you live in states like Iowa or Illinois, this means your local farm community is staring down another risky harvest. And that has ripple effects. If corn doesn't move, Feed costs go up for dairies and poultry farms. So while corn may seem dirt cheap, you might still see egg prices climb from $2 to $2.30 per dozen next month. At the same time, Canada is stepping in fast, sealing premium corn supply deals with the EU, South Korea, and even Mexico, which just turned down U.S. product. That doesn't just put America on the back foot, it shakes the foundation of the entire domestic ag economy.